Good afternoon and welcome this afternoon to Advanced Charting Techniques, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Kevin Horner out there in the chat. Kevin's a 28-plus year veteran of the financial markets and a great technician in his own right. And I'm glad to have Kevin on board with us. He's going to be out there to help answer the questions. If you're here with us live, be a part of the conversation, chat some questions in. If you are here in the recorded version, which we're glad to have you here too, leave us a comment in the comment section. Filling in for Cameron May today, and my opportunity to spend a little bit of time talking about a subject that I like to talk a lot about. I do it on the road quite a bit in our technical analysis and option strategies live workshops. I've dropped into this particular webcast a couple of times from the road, from our live workshops. So you've probably seen me if you've been in this webcast. So we're going to be in, by the way, San Diego next Saturday, not this coming Saturday, but the next Saturday following that, doing a market drive event. And then we're going to be in Atlanta doing a technical analysis and option strategies workshop. We'll talk a little bit more about those opportunities here just coming up in just a little bit. A couple of quick housekeeping items, and just to give you a preview of what I want to talk about today before we get to those housekeeping items. Obviously, there's some movement in the market today, and there certainly has been a bit of a tone change. And oftentimes, one of the questions that comes up when we talk about technical analysis is what indicators might give us some insight into that tone change. So we'll talk about oftentimes the idea of using a single technical indicator with price as king. Today, we're going to talk about the idea of maybe using some additional confirmation to price and a single technical indicator. So we're going to put together a system some of you might be familiar with already. We're going to talk about it, and we'll see if you recognize some of the things that we might see in today's discussion. A couple of quick housekeeping items, though, as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only and is not a recommendation or any endorsement of any particular security or strategy. We're probably not going to talk about options in this discussion specifically today, but if we do, and if you are considering an option strategy, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, technical analysis is only one way to look at the market. Probability analysis, fundamental analysis also factor into things. All of them are theoretical in nature. None of them are guarantees. None of them can predict what the market is going to do. And so Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We may put some sample trades together today. If we do, and we use some stop orders, remember that stop orders, whether they're talking about buy stops or sell stops, that generate a market order are not guarantees of what price that order is going to get filled at. And if we create a stop limit order, whether it's a buy stop or a sell stop, it doesn't matter. There is the potential that that order might not fill if price moves quickly around the range established with the limit order. So we'll talk about that as we get into that discussion. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It's not a guarantee future success out there in the real world. It doesn't do certain things the way that a live trading platform would do. So there is a difference as you move your practice from paper trading to live trading. Recognize there are some differences as well. So we'll get into this discussion here really quickly. We're going to talk a little bit about how we might impact or implement some of these technical price patterns, talk about the pros and cons of putting these patterns together. We'll look at some examples on the chart. Lou says, buy a magic 8-ball. Yeah, that's an interesting concept, right? The idea of a magic 8-ball being predictive and saying, hey, does this totally unrelated piece of information give us some sort of insight into what might happen in the future? And sometimes it seems with technical analysis, as we pop over here to the Thinkorswim desktop software platform, that it is a little bit like a magic 8-ball. That's if we are using technical analysis as a predictive tool, trying to predict what the market is going to do. Because what we know is that news changes everything. And because if news changes the market movement, unless you knew what the news was before the news came out, unless you were perhaps a part of creating that news, you're not going to know how the market, that it was going to come out, number one. And number two, even if you were a part of the news creation, you don't know how the market is going to react. Case in point is what happened today, which was widely anticipated, but nobody really knew, I think, how the market was going to react to the Supreme Court decision on tariffs. And so what we've seen today in the market, and I've been on the network, which is the Schwab Network, which is brought to us by our media affiliate, Charles Schwab Media Productions, which is a separate but affiliated company. The conversation was around the idea that perhaps the risk in today's movement was to the downside, given that that potential for a Supreme Court decision. What's happened, though, if we look at today's market, is that price has moved back up here in the S&P 500, back up to the 50 period, in this case, simple moving average, and it's testing above that level. So there's some upward pressure. Still, there's, to be sure, a lot of uncertainty in the market. The NASDAQ a little bit stronger here, giving us a bit of a bullish engulfing, but well off of that 50 period moving average here in this case. And we look at the Russell 2000, which we think might, potentially have had a bigger impact from that tariff relief possibility. In fact, the laggard of the three. So in that particular case, we don't know. We never know how the market is going to interpret news. So all we can do is make a decision-making paradigm, right, or a decision-making framework. And when I talk about this on our technical analysis workshop, when Kevin's with me up on stage at one of those workshops, when you all are there and we have that conversation, we talk about this idea of if this, then that. If this happens, then this is the action that we're going to take. And we can do that with an individual symbol, right? We can simply say, we can do it with the market as a whole. If the market moves up, then we're going to take a bullish stance. We can do it with an individual symbol. We can say, if this symbol moves higher, then enter a trade. And if it moves lower, then exit a trade. That's kind of the simplistic way to think about it. So then we start to put a little bit more specific information to it. If the symbol that we're looking at is in an uptrend, meaning it has higher highs and higher lows, then enter the trade, else wait. Or if the symbol that we're looking at is in lower highs and lower lows, then exit the trade, else wait, right? So all we're doing is we're continuing to build this decision-making framework. Let's take a look at an example here. I'm going to shift to just my single grid chart. For those of you that are familiar with this, we've seen this single grid chart a number of times. I'm just going to hide all of these technical indicators here. We're just going to look at price. And the stock that I'm going to look at is this one, MNST, Monster. And you can see that Monster, in this case, let me grab this and kind of move it down. I kind of stuck that there. I've got some previous trend lines that I've drawn on here, but I can make this argument that Monster, in this particular case, fundamentals notwithstanding, because fundamentals might be a way to build a watch list of things that we might want to trade. Technicals may give us the timing and, again, that decision-making framework. So technicals aren't going to tell us anything about the fundamental nature of the company behind the price move. And you think about what price is, this price that this stock is currently trading at right now, the 83.63, the baseline assumption that we have to make in this particular case, and in every case, I think realistically, is that $83.62 price that's currently being offered is a reflection of everything known and everything anticipated and everything feared and everything hoped for in the price of this stock. That is what currently the market is willing to assign the price of this stock to be, taking into account digestion of all of that fundamental information and everything else. That's the reality of what price is. Now, what price could potentially do is a function now of behavior around what that price is. So Monster has been moving higher. It's been making higher highs and higher lows. Do I know for sure that it's not going to keep going higher? I don't. Do I know for sure that it's not going to reverse and go lower? Especially since we've got new information coming into the system here. We've got an earnings announcement over the horizon here a little bit. So at the moment, all that I can go on as a technical analyst, as a trader, as an investor, is the past and make a decision around that information with a sense of probability. What's likely to happen? I don't know for sure. And no technical indicator, and I'm going to tell you this again, no technical indicator, advanced, simple, paid for, free, AI generated, or otherwise, can tell us the future. No leading indicator, which isn't really a leading indicator. No volume weighted average price variance, whatever it might be, is going to tell us the future. That's just the reality of the situation. So all we can do is make a framework-based decision. Now, I can tell you the future in a very small sense. I noticed that in the chat, there is a feedback survey. So my prediction of the future, and hopefully it'll come to pass, is that you will take an opportunity to click on that link, fill out that feedback survey, and let us know how you feel about this webcast and how we can make it better for you. That's my prediction for the future. All right, so there you go. Yeah, Kramer usually does. He's a great leading indicator. Okay, he's wrong too, but I get it. I get what you're saying. All right, so let's take a look at this. We got Monster that's moving higher here, right? And we could draw some trend lines here. We could just draw across those lows. We could draw across those highs. It's making lower highs, higher highs and higher lows. And so we could just simply objectively say, if price is making higher highs and higher lows, then enter the trade. So could we enter the trade here? Yeah. That framework gives us permission within our behavior and within what we see happening here to enter the trade. And then we could say, if the price now starts to make lower highs and lower lows, then exit the trade. And that would give us a point at which we could perhaps then say, I want to get out of the trade. So where might that be? Well, we might draw another line to help define where that series of lower highs and lower lows might be. So if it breaks this low right here and comes back down, and now makes a new lower low and then a lower high. So it's probably likely that we're not going to see a breakdown or a change in that trend in terms of lower highs and lower lows until we get below some of these previous levels of what we call support and resistance. So we're above a level of resistance. We've broken out above that level of resistance. Thank you, Newzar. I appreciate that. And we've got a level of support there down around that $80 mark. So those could be our decision-making paradigms. Enter the trade if it goes above 82. Stay in the trade. If it breaks below 80, then exit the trade, right? If this, then that. And that's based on objectively and empirically what is happening to the price of the stock. Now, we can do that kind of on an ongoing running basis, right? We can determine where those levels of support and resistance are. We can draw those lines to those levels just discretionarily as we draw those lines. And I don't take that particularly precisely. I'm not matching up those lows or those highs exactly to the penny. I take more of that not too particular, not too precise approach to this scenario and say, hey, if I can connect those dots where it makes sense, then that's probably a level of support. It's where price has changed direction before. But one of the other tools that we could use here is something that is maybe a little bit more objective than just drawing a subjective level of support and resistance, a little bit more mathematically defined. And if that's the way that you like to do that, that's great. If it's not, if you like to just draw those levels of support and resistance, that's absolutely fine too. So what I'm going to do is I'm going to turn on this chart. I'm going to turn on a, say, a 50-period moving average. And I'm going to say, all right, fine. As long as that 50-period moving average is trending higher, then stay in the trade or get into the trade when the price bounces up off of the 50-period moving average. So we might have entered the trade back here, or get into the trade when it crosses from below to above the 50-period moving average. And we might have gotten into the trade back here. But I notice on this particular stock that doesn't give me very many entry opportunities, keeps me in the trade for a longer period of time, but it doesn't give me very many entry opportunities. And if I were waiting for a pullback below that level of support that's indicated by the 50-period moving average, then that might be getting me out of the trade. If this then that statement was, if price breaks below the 50-period moving average, then exit the position. That takes me out. Stock's currently trading at 83. It might take me all the way down to 78. That's a pretty good chunk of change before I get out of the trade if I'm a short or an intermediate term trader. If I'm a longer term trader, that's probably maybe in that appropriate range. Maybe. I don't know. Not my trade. So in this particular case, we might tighten up that moving average a little bit, maybe add a faster moving average. That might be more indicative of the time frame in which we are trading. Now, if you're a longer-term investor might use a 50-period moving average as an entry signal and looking to get in on those major waves, sea swells that the market is making here, or this particular individual stock. A shorter-term trader or a shorter-term investor, a swing trader, might use the sets of waves that are moving, the shorter or intermediate term trends that are happening as a means to enter and exit the trade. Right? And Kelly says, I plan to be out before earnings. Yeah, that's one way to protect against that potential on that earnings announcement. But look, the last two earnings announcements have been positive surprises and they've moved to the upside. Doesn't mean that the price of the stock is going to do it again, but that's certainly one way. Now, by the way, we've got some great webcasts, Kelly, that talk about using some other strategies besides just exiting a position or just trading a short-term trade ahead of an earnings announcement or waiting until the earnings announcement has passed to make it to place the trade. So we've got some strategies that we talk about using option strategies. Again, we're not going to talk about this in the context of this discussion, but option strategies, remember, if you're going to trade those, make sure you understand the characteristics and risks of those strategies before you consider those. Might be some that could be used as a means to manage a long stock position around an earnings announcement, or at least help to define risk somewhat. All right. So now that we've got this idea, we might change the length of time on this moving average. So I might come over here and I might just edit it with the gear icon and come back down here to the 20-period moving average. Let's make it 20 periods in this case. We might even make it 30 periods or whatever. We can kind of adjust it and play with it and see. Let's make it 20 periods to be part of this discussion and say, oh, is it too late to buy now? Not necessarily. And the question is, who says it's too late to do anything, right? Because if we were looking at the 50-period moving average and that was our measurement of getting into the trade, maybe it was too late. It's already made a move, but it's still moving in a bullish trend. And in fact, it's just breaking out of some short-term resistance here today. So if we're just looking at this and saying, is it too late to buy? I mean, from that standpoint, no. Okay. All right. So starting to see that move to the upside here. But take a look at this. If we move that moving average from a 50-period moving average to a 20-period moving average, and we say, oh, cool. Now, the shorter-term moving average more closely reflects the movement of the price of the stock relative to the length of time that I may be in trade. So if I'm a shorter to intermediate-term trader and I'm trading from days to maybe months, then this might be more reflective of that trade. Now, 20 periods or 20 days might not be long enough. Maybe we adjust that to 30 periods or 30 days. Doesn't matter. I mean, again, it's going to be fairly close. And, if you want to, you can experiment with things like a 30 period or different period of time, different types of moving averages, exponential moving averages, displaced moving averages, Hall moving averages. Doesn't matter. In fact, I've got a webcast that I taught just a little while ago where I compared several different moving average types to see which one was quote unquote better. And first of all, I'll tell you, I'll spoil it for you. There is no one better. Second of all, each one of those different types maybe works in a different situation. So that's a good thing to kind of keep in the back of your mind. That don't get dogmatic about technical analysis, and especially when it comes to charting techniques like this. But if I've now shifted this 50 period, what was a 50 period moving average, to a 30 period moving average, I can see, you know what, that's probably not quite as tight as maybe I need to. So maybe I need to shift that a little bit, even a little bit further. And that's one of the ideas in terms of fitting this curve, technical analysis, and whether you think that this is an indite of technical analysis or not. It is what happens is we fit curves to what we fit responses, we fit information to what we see going on. So I've now adjusted that simple moving average to be a 25 period moving average. We see that that price is bouncing up off of that 25 period moving average. It's done it down here. It's done it right here. And so when I say find a moving average or find a time frame that is reflective of what the price of the stock is doing and what it incorporates and how it behaves, that's how you do it. You kind of try to dial it in. So Thea says, is this AI? Nah. That's just me doing the 25 period moving average here and adjusting that. And I honestly didn't even look at that 25 period before we came on and started to look at this, but I just happened to notice that given this period, this moving average, it bounced there, it bounced there, it bounced here, it bounced here, it bounced here. So this is probably a moving average that is reflective of a length of time that makes sense for this particular trade. So for this particular stock. Now, what we might say then is if price breaks that 25 period moving average, which it hasn't done here, and it didn't do here, and it didn't do there, and it didn't do it there, when we might exit the trade is if it closes below the 25 period moving average in this particular case. And you're right, Helen. Different timeframes and investor objectives change the way that we look at things. Now, I will tell you this, my good friend Kevin Horner, who is out there in the chat right now, has something, and I don't know all of the rules to it, but he calls it the Horner rule. And the Horner rule is when you see a break of a level of support, or you see a break of a trend line, or you see a break of a moving average level, you got to wait a little bit. You got to wait a little bit for that to happen. So, Kevin, I'll let you kind of explain that a little bit more out there in the chat. But that Horner rule says, hey, I got to wait for something to happen and I got to give it a little bit of time so that we just don't get kicked out on that initial move. All right. So that's great. Now that we've kind of established this parameter, Barbara asks a great question. Are there any universal principles about choosing moving averages? Yeah, I think there are. I mean, I think the universal principle is you may want to consider having a short term, an intermediate term, and a long term moving average so that you can see the relationship of those moving averages. So in this particular case, I've got a 25 period moving average, which is a short term. I've got an intermediate period moving average, which is a 100 period moving average in this particular case. And I've got a long term, that's the 200 period. And if that universal principle is just simply this, look at the trend direction indicated by those moving averages. If they're in concert with one another, then all of those trends, short, intermediate, and long, are all moving in the same direction. If there's a divergence of one versus the other, that can tell you something about the price movement. So I've got 3 different moving averages here. That's one way to go about doing it. The other way to think about it in terms of a universal principle is what those moving averages are doing relative to where price is. So where is the price of the stock relative to the whatever period moving average that you're using? If it's above, it's generally bullish. If it's below, it's generally bearish. And that may be the way that you think about it. So even if you're a longer term investor and the price of the stock is below the 200 period moving average, that may be a bearish signal. If it's above the 200 period moving average and you're a long-term investor, that may be a bullish signal. So that crossover, right? That crossover between a moving average and price is going to be an important consideration. So what I'm going to do is I'm going to change my grid here really quickly. And I'm going to go to my 3 green grid, and you'll see what I mean here in just a minute. So we're looking here at, let me pop up here, MNST Monster. And here's Monster. There's those lines that we drew. And I'm going to take some of these off. I'm going to take this one off. I'm going to take this one off. I'm going to take this one off. And we're going to start, in this particular case, with that 30-period moving average. And in fact, I'm going to adjust this down to a 25-period moving average, because we already established that that is where perhaps we're getting more bang for our buck in terms of that moving average moving relative to price. And what I've added here is a moving average crossover study. And I'm going to adjust the study to take my length of time to be 25 periods. So I've got a 1-period moving average, which is price, and I've got a 25-period moving average, which is that moving average. And I'm going to show an arrow when price crosses from below to above. That's going to be 1 point of confirmation on this particular setup. So I'm going to look for that crossover. Now I want to display that 25-period moving average so that we can see where we are relative to it. We can see there's that 25-period moving average, and you can see what this indicator that I've set up so far is doing. I'm getting an arrow pointing out where price has crossed from below to above the 25-period moving average, from below to above the 25-period moving average. So all I have to do is I have to look back and see what the color of that, or whether or not there was a green arrow most recently. So this had a recent crossover, well, of course, the last couple of months, crossover of price from below to above the 25-period moving average. So that gives me that one confirmation. This is bullish. I can say that objectively. Now, you might say, well, okay, but I don't want to get in on that breakout unless there is some oomph behind this move. Some oomph behind that momentum, or momentum behind that move. So I may want to add some kind of an indicator that tells me about momentum. So you know what I'm going to do? I'm going to come back up here to my flask icon, and I'm going to add on here a momentum study, something like the MACD, the moving average convergence divergence, which is going to tell me when a fast moving average is moving up and away from a slow moving average. And that's going to give me an idea that there's some oomph or movement behind price, especially if it's staying above a trend line or above a moving average. That momentum indicator can be a helpful tool. So I'm going to add that MACD histogram. I'm just going to do that by typing in here MACD, MACD histogram. And then what I've done is I've edited that to show those crossovers. Okay, those crossovers in this particular case. So I'm showing or displaying a bullish momentum crossover of that 0 line in that MACD histogram. So showing that breakout signal if it goes above, showing it if it drops below. So the down signal is a orange arrow, the up signal is a green arrow. And so what I'm going to do is I'm going to click on OK, and we're going to display this. And that's one of the things that's already built into we don't have to script this or code this or anything else. By the way, Mike Fairborn is going to be coming up later this afternoon talking about think scripting. We're going to click on apply and OK, and you can see what has just happened recently. So I'm going to zoom in on this time frame right here, and I'm going to say, look, if we were looking at this time frame right here, let me kind of adjust this so that we can kind of squish this around and see it a little more openly. So here's I'm going to take this trend line off so that we can see that 25-period moving average. So it's bouncing along, and it's bouncing along, and it's bouncing along, and we might say, look, I want to get in on this bounce, right? Well, Barbara, that's a good question, because what is price? It's a 1-day moving average. So a 1-day moving average moving above or below another period of time moving average is going to slow down that signal. This is going to be the fastest signal that we can get. In this particular case, is a 1-period moving average, or in other words, price moving above or below whatever designated period we want to talk about. So if you wanted to slow that down, you could use a 5 period and a 20 period, or a 2 period and a 25 period, whatever it is. Experiment with it. But here's what I'm getting is, if we were looking at getting into this trade, we might say, hey, I want to get in on this bounce right here, or I want to get in on this first breakout, but I want to do it when there's some price movement with momentum. So I want to highlight this period of time right here. Let me just grab my magic marker. We're going to highlight this. So I'm going to highlight this right here. Breakout of that resistance level that had been established here and here and here and here and here. And what was it doing in terms of momentum? What was it doing in terms of momentum? If I bring this back up here so that you can see it, we had a breakout, but at that particular point in time, we had a breakout with still negative momentum. So we might have waited at that particular point and said, no, just because I had price moving up from that moving average doesn't give me all of the information that I need to get into a valid entry signal. So for instance, right here today, when we get that breakout today with a momentum shift, meaning momentum has now moved from negative momentum to positive momentum. This price breakout today above a resistance level. So here's our if this then that statement. If my uptrending stock, as indicated by the 25 period moving average and a green arrow on the 25 period moving average, breaks above resistance level and has positive momentum, then enter the trade, else wait. So we've now given ourselves a much more granular decision-making point to get into this particular trade. We're waiting for momentum to follow that price movement. Higher probability of this trend continuing to move higher. Is it a guarantee? No. Could news happen? Yes. Could that change our trend? Absolutely. But this gives us a higher probability entry into the trade because we've got momentum kicking in as this breaks above a resistance level. If this, then that, but it's now a more nuanced if this, then that statement. Cool, right? So what we've got that gives us kind of that permission in this particular case, if you want to think about it from that standpoint, permission. Nobody's giving you permission. You are the master of your own destiny when it comes to getting into and out of trades. But our permission in this particular case, given this setup, comes from the fact that the price is above the 50 period or 25 period moving average. It's broken out above resistance, and we've got positive momentum. 1, 2, and 3. We've got 3 points that we can use to validate this entry into the trade. Because I will tell you that statement right there, validating my entry into the trade behaviorally, is what gets a lot of technical traders. Am I making the right decision? Am I doing what is this okay to place this trade? And the answer is, if this is your validation, break above resistance, uptrending stock, above the 25 period moving average with positive momentum, there's your validation to get into the trade. So to go right along with the Horner rule, choose your own confirmation, choose your own validation, right? So that's the question that we ask. Am I okay? I mean, isn't that the question we always ask? Am I okay? Am I okay getting into this trade? Well, yeah, it's got validation. Doesn't mean that if it goes down tomorrow that we are invalidated or that our thought was wrong. We're not wrong. We placed a trade that was good. News changed. So now let's add one more complexity to this. So we've got momentum. We've got trend. Maybe we add into this mix sentiment as well. So the other indicator that I'm going to add into this mix here is a sentiment gauge. Now, sentiment is a little bit different, right? A little bit different than momentum. Momentum is simply price movement relative to other price movement. Sentiment is a little bit different. Sentiment can be an indication of kind of the aggregate of that, kind of pushing one direction or the other. So Barbara asked a great question. How much more risky is it to trade if MACD is turning less red? Meaning this point right here where it's shifting from downward movement to upward movement. You might get in earlier. That's a good question, right? Is getting in earlier worth it versus less confirmation versus waiting a little bit and more confirmation? And in terms of risk, I don't know that it's a risky standpoint. I think it's a probability definition, because risk is determined by where we exit this trade, not the risk of the price of the stock. Let me say this again. The risk here is a function of where we get out of the trade, not a function of whether it goes up tomorrow. That's not a risk. That's a potential, because it could. We can't control that or define it. What we can define is where we exit the trade. That makes sense? So it's not a riskier trade. It's we're willing to get into the trade with less confirmation, so we define our risk appropriately from there. So now let's add to this component. Let's go to the Flask icon here, and the next one that I have is a fast stochastic as a sentiment indicator. Really, what kind of is the thought process in terms of investors pushing price within its range? And I'm going to click on apply and OK. And so now I have that stochastics, that fast stochastics indicator. And this fast stochastic indicator is just a complement to that MACD. Could you do this just with the MACD and the moving average? Absolutely. Could you add some complexity to it with the stochastics? Yeah. So what I've got here is a breakout indicator, and basically it is a turnaround indicator. It is when that stochastics indicator turns from above or from below to above its lower reversal zone, or from above to below its lower reversal or its upper reversal zone. So we got that green arrow right here. Then it went up and it pulled back a little bit without a lot of sentiment to the downside. And then we got this crossover back here to the downside. But notice what's going on in this particular case. Let me kind of zoom in here one more time. I'm going to zoom in on this arrow right here. It never went down into this lower reversal zone. So this is what we call, if some of you will remember this term, a phantom green arrow, the phantom green arrow, because that stochastics reverse direction above that lower reversal zone. So we still have kind of that entry confirmation, breakout above, momentum moving higher, and sentiment moving higher as well with a phantom green. So if we were to look at this, we could say one green arrow on trend, one green arrow on momentum, and a phantom green on sentiment gives us a potential entry signal into the trade that is higher probability, not any more or less risky, because that's defined by where I exit the trade. And so if I use a stop order, that's going to be my determination of my risk in the trade. But in terms of probability, this has a higher probability of moving up and continuing that trend unless news changes it. So you know what I'm going to do? Right click, and I'm going to buy, and I'm just going to buy custom with a stop. We're going to put a stop order in, and I'm going to put it below this level of support down here at the $80 mark. I'm going to give this about $3 of room to play to the downside. I'm going to go 80.21 as just kind of a different number to get out of that stop, or to get out of that trade. I'm going to make that good till canceled. And we're going to look at getting into this. We're going to try to work this just a little bit inside that bid and ask. Click on confirm and send, read through that order, and we're going to put this in our market movers group and click on send and fire that order off. And we'll see if we get filled here inside that 83.80. That was our limit price. All right. So this set of tools, there we go. We got filled. We've got our stop order in place to help us define our risk. Now, is there any guarantee that this is going to continue to go up? No. Is there a probability that it's going to continue to go up? Yes, there is. Because we've got trend, sentiment, momentum all in our favor. Let's take a look at another potential example here. And this is one that Kevin talked about this morning on the Schwab Network. By the way, Schwab Network, again, brought to us by our network, our media affiliate, Charles Schwab Media Productions, separate but affiliated company, and that's LYV. And Megan says, what would be a target price to sell? I don't know. If I'm a trend trader, and I'm just following the trend as long as the trend goes, I don't have a specific target. If I'm a swing trader, it might be some measurement objective there. So let's take this LYV and let's see what we've got at the moment. And let's see if we've got permission to enter this trade based on this idea that we've talked about. So green arrow on momentum, green arrow on sentiment, green arrow on price. So even though this appears to be higher and significantly higher than that moving average, do we have permission to enter the trade based on this? Yeah. And then what I might do in this particular case is define my level of support. So could I enter this trade on this breakout above resistance with 3 green arrows of price, of confirmation? Absolutely. Because now I've taken what is an ambiguous trade and I've put some definition to it. So given that idea, that's what that 3 green arrow method, using those 3 confirmation tools. And I would tell you this could be RSI, this could be slow stochastics, and this could be a 10-period moving average. It could be a 50-period moving average, it could be ADX, and it could be the awesome oscillator. It doesn't matter. There's no one better indicator. Just put something together that gives you a sense of validation and confirmation to that entry, and then define your risk by where you're willing to get out of the trade. So that's how we might approach this perspective of charting using tools that can give us some additional confirmation. I'm going to look at one really fast. We're going to pop back here. This is one that I was looking at that was on a possibility, DAL, Delta Airlines. Okay, so notice what I've got here on Delta Airlines. I've got a couple of scenarios here. Still in an uptrend, right? The moving average is kind of trending sideways to up. But I had a recent green arrow. It's pulled back below. And if it closes above or trades above that 25-period moving average, I'm going to get a green arrow there. So I don't yet have confirmation on price. I don't yet have confirmation on the stochastics. And I don't yet have confirmation of the MACD. So it's not there yet. So in order for this to be a valid entry into this trade, because some people are saying, oh, I'm going to get in on this bounce and I'm getting into that absolute low. Well, I want to see confirmation. I want to see price breaking above that 25-period moving average. So if price breaks above 25-period moving average and I get a green arrow on the stochastics and I've got a green arrow on MACD, then enter the trade. Okay. So we go back to LYV. LYV. Here's what I've got. 1 green arrow, 2 green arrows, 3 green arrows. So I can wait. I don't have to wait. And I've got a breakout of resistance. So I've got all of the circumstances that allow me to enter that trade based on the premise that we've established. So you know what I'm going to do, guys? I'm going to share this with you really quickly here. I'm going to share this grid so that you've got it. You can take this away. Remember, anytime we share anything, it is for illustrative and educational purposes only. It is not guaranteed as to time or accuracy. Let me prop you back over here to the webcast page. If you haven't done so already, click here on subscribe. And what I'm going to suggest that you do is you pop over here, Scott. I'm going to type in Scott Thompson because Scott Thompson teaches this webcast, which is stock investing for beginners. Now, some of you are not beginners. I know that. But here's what Scott Thompson does in this webcast is he breaks this idea down of getting into a trade using tools just like this, helping you to gain that confidence in getting into and out of trades. Give us a follow on X at Ben Watson CS, at Kevin Horner CS. Follow us and join us next week. By the way, next Saturday, go to the Schwab.com events page. We're going to be at the Market Drive in San Diego. Kevin's going to be there. I'm going to be there. Barb Armstrong's going to be there. Joe Mazzola is going to be there. And you can still join us. We'll buy you lunch. We'll buy you breakfast. We will buy you beverages of your choice at our networking reception, and it is at no cost to you. Love to see you there. Have a great weekend, everybody. Have a great Friday. Thanks to Kevin Horner for helping out, and Bree and Gabe and everybody else. on the production side. We'll see you soon. Take care, everybody. Bye-bye.